Recently, rising yields on government bonds, i.e. government debt, have caused concern for markets and central bankers. Today, we consider how and why yield curve control could be implemented and why it could even mean we are forced to buy government debt. So let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. So we've heard a lot about yield curve control in recent times, and it is already being used formally by the Reserve Bank of Australia. Essentially, it caps interest rates or yields of government bonds. They may set a target yield on a specific maturity government bond. For example, in Australia, they target a yield of 0.1% on the 3-year government bond. And so just to remind ourselves that bond prices and their yields have an inverse relationship. So a $100 bond yielding a 1% or $1 return per annum may rise in a bond boom to $200. But that $1 return now only represents a yield of 0.5% or just that $1. So in targeting a specific yield, the central bank will buy government bonds when yields rise above this target to depress the bond yield. And so here is the yield curve in white for the US, with the maturity of the bonds on the horizontal and the corresponding yields on the vertical axes. The longer you hold a bond, the greater the risk of inflation and solvency issues, so the greater the premium demanded by bondholders. Now, what we can also see here is how the yield curve has steepened significantly since 1 year ago, where the yield curve is marked in blue. Normally, a steepening yield curve reflects a promising economic outlook, or alternatively, it reflects concerns regarding inflation, where investors demand a greater return on money that is parked in government debt for longer periods of time. And rising inflationary concerns have been causing much disquiet on the markets recently. But over the course of the last 40 years, the bond market has been in a real bull phase. Just look at how US 10-year government bond yields have fallen dramatically throughout this period. And this really shows us where the real bubble is. It is the debt or the bond market. And this bond bubble has been fueled by previous rounds of quantitative easing and interest rate repression. This has spurred on the debt binge, and global debt has been estimated at around 355% of global GDP. While the US economy has now amassed over 130% of GDP as their national or government debt. Rising yields cause a dramatic rise in the cost of borrowing and threaten the solvency of a nation. The evidence of the size of this bond bubble was really emphasised by the relatively small move in bond yields that has taken place but caused much market disturbance. But recent central bank policies is just so extreme that the ECB bought more than 100% of net bond issuance from Eurozone states to prevent bonds rising from already such incredibly low levels. Just think what level of interest premium you would actually want if you were going to lend money to your government for a 10, 20 or even a 30-year period. Well, do let me know in the comments below. In the words of the economist Daniel Lookout, they are disguising risk with liquidity. But quantitative easing also has the impact of removing bonds, the alleged risk-free asset, from the market, while trying to actually change the perception that the economic cycle is set to turn and that investment into productive assets should take place. The key problem is that all those involved in the market are aware of the heavy hand of the state in manipulating the bond market. Thus, investors rush for liquid risk assets such as equities. That really explains why equities have been on such a tear. Moreover, low interest rates push liquidity to the least productive parts of the economy and perpetuate the existence of zombie corporations as well as rising house prices. This all promotes allocative inefficiency of capital and results in dismal productivity gains. If rates were allowed to actually rise, firms that have been kept alive by artificially low levels of rates since the 2008 financial crisis could go bust, and the capital could be reallocated to those firms with real growth potential. Higher rates would also help to curb fiscal ill discipline of governments globally and greatly reduce the power of the state. As it is, the attempt to cap yields, though, through yield curve control will promote government excess and remove the potential productivity gains for small, medium-sized businesses who employ around 70% of the workforce. Thus, yield curve control will suppress real wage growth. And so if central banks decide to undertake yield curve control themselves, which is widely expected within the market, it is a potential recipe for the ultimate equities melt up, while also raising serious concerns regarding the potential for a significant inflationary burst, if not even hyperinflation. As banking expert Professor Richard Werner puts it, central planning at its best. The ECB massively expanded money creation in 2020, which will cause inflation, as I warned in April 2020. This pushes up bond yields. The ECB reacts, let's push down yields by printing more money and buying more bonds. But doing so runs serious risks. It is ultimately a pledge to never raise interest rates and allow permanent expansion of the central bank's balance sheet. This approach would necessitate other counter-inflationary measures to be implemented to just try to keep a lid on inflation. Such measures could include rent and price controls, restrictions on credit growth, and rising taxation. Moreover, the central banks have to remain true to their target, yet exiting a yield curve control mechanism could prove immensely problematic and potentially trigger a bond market collapse. The alternative approach is to force saving institutions to buy all of the government debt at a certain level for a certain maturity bond. This could mean any currency saved away in our savings accounts is used to buy up government debt. Remember, the bank regulator, the central bank, can determine bank policy. This second approach is the one which economist Russell Napier believes is most logical. It would not result in the same inflationary outcomes and would stifle equity valuations, as banks would have to sell their most liquid assets to buy bonds, and those most liquid assets are likely to be equities. And so what should we do to counter this? After all, the returns offered to savers will be dire in real inflation adjusted terms. Meanwhile, the other inflationary stimuluses that have been implemented by central bankers will remain, be it credit guarantees to banks, furlough payments and other fiscal stimulus measures. In the face of this inflationary onslaught, precious metals have real potential to do well, as do certain cryptocurrencies. In essence, removing your money from the banking system is likely to be the best way forward, something that I've promoted a number of times on this channel. Now, do let me know your thoughts. In the meantime, do check out this video where I look at some of the best assets for stagflationary environments. But anyway, thanks so much for joining me, and I look forward to seeing you next time. Bye bye.